Should I invest with a lump sum or dollar cost average?
It's Brian Preston, the Money Guy.
Hey, Money Guy family. It's your host, Brian Preston, with my co-host, Mr. Bo Hansen. We're going to go beyond common sense to take your finances to the next level. So should you invest with a lump sum or dollar cost average? Let me give you some cold, hard facts, unemotional facts about what's going on here. Here's the thing, Bo. There are so many blog posts. There's even other content. There's studies out there
about this.
And people, because here's what we're talking about. You get a lump sum of money.
Maybe you sell a business, life insurance, inheritance.
Yeah, let's just say it's cash of a lump sum. Do you invest it all at once, or do you start putting it in over time? Because that's what dollar cost averaging it is that you're putting it in over, whether it's monthly, whether it's quarterly. You're coming up with a system.
Sure.
To try to break up the contributions. And the facts are, without a doubt, lump sum investing is superior to dollar cost averaging. About 66 to 67% of the time. And we know this because Vanguard did a study in 2012 where they went all the way back to 1926 through 2011, and they said, okay, on rolling 10-year periods, should you over 12 months dollar cost average, and this is $1 million portfolio, or should you
put it all in right there at the very beginning?
Well, common sense tells you, okay, the lump sum's going to do better because we know markets typically somewhere between 70 to 80% of the time they make money. It's good to be an investor in the long term. And a 60-40 portfolio is about the same. It's even better. But here's the thing. I think that there's a lot more going on. We're not robots, not yet anyway. So there's more going on, and I think these numbers that I just gave you don't tell the full story because there's a lot of things that happen. Your emotions happen. We are definitely emotional creatures, and I want to talk about materiality and size. Maybe it's because I'm an accountant by training and a CPA, but I think that there's a difference between if we're talking about $10,000 versus if we're talking about $400,000.
Sure.
And what I mean by that is you invest $10,000 with a lump sum, the market takes, let's just say a 20% dive.
Right.
Because it could get as bad as 2008, the market lost 37% if you're talking about the S&P 500. So a 20% drop on a $10,000 investment, you're talking about you're walking away from $2,000.
Right.
I mean, and that's horrible. You're like, oh my goodness, I put in $10,000, it's worth, $8,000, I lost $2,000. But now I want you to visualize and say, okay, I invest $400,000, I lose 20%, that's $80,000. Now we're talking about it took maybe years to generate that much income, and then income to turn that into savings is even a bigger number because of taxes and all the other things. You start having to ask yourself, is that the same answer? Is 10,000 the same as 400? What about somebody who just left the workforce? They get this big pension lump sum, because that's one of the options that happens. People get the option to take this big lump sum of money or roll it over or what they're going to do with it, or you get an inheritance. Mm-hmm. If you have left the workforce or you now come into this money because you just lost a loved one, don't you think that's probably when you're your most vulnerable state as well, is that you, oh my goodness, I've just left the workforce, I've got all these changes, I've got all these stresses, my world is evolving, it's changing, and now I have to worry about if the stock market's going up or down. And I know, yes, historically it's going up 70, 80% of the time, but I've got a lot in play that freaks me out because if I screw this up, because remember, 2/3 of the time it's better to lump sum invest. What about that other third? That would
a lot to gamble on.
That would give me some fear.
And you have to understand a little bit about your personal profile, your personal preference. Are you somebody who, if you invest at the top of the market in 2007, it drops and you're going to kick yourself and you're not going to be able to sleep at night? Or are you somebody, if you dollar cost average in 2013 and you miss out on some market performance, which one of those weighs more heavily on you? Which one is going to cause you the most emotional distress?
Well, I gave you guys the numbers. I feel like I need to give you the rest of the story too. And then I want to kind of talk about what's the planning that you can do off of this. We gave you the numbers that Vanguard determined that two-thirds of the time lump sum investing was better. So the next question I would have was, well, how much better? How much better was it really? And here's the numbers. So remember, this was a rolling period, 10-year period, starting in 1926 data all the way to 2011. They put in $1 million and spread it out over 12 months. Well, that $1 million on average with a dollar cost averaging strategy turned into $2,395,000 and some change, close to $2,396,000.
Okay, so $2.4 million.
So the lump sum investing turned into $2,450,000. So
$2.45 million.
You start scratching and go, okay, they're both worth $2 million. They turned $1 million into $2 million. What's the difference? It's $54,000, which works out to be 2.3% difference. Now realize this is over 10 years. We're talking a 2.3% difference. I have to ask you at that point, if there's a third of a chance that you're going to get unlucky and this thing goes bad, is it worth to pay an annual 25 basis points premium to know that you're not going to get stuck?
Or even a different question is the emotional roller coaster worth that 1.5 to 2% at the end of it? Do you want to feel that emotional strain and that emotional distress for, truthfully, not a whole lot of money in the grand scheme of things?
You had mentioned in show prep, Bo, that this was the best of both worlds. It gave something for the Bears. It gave something for the Bulls. Explain what you mean by that.
Yeah, so what happens is if you lump sum invest, you hope you get lucky. You hope you lump sum invest at the bottom and the market goes up. Well, when you dollar cost average, you don't have to be as right. If you start dollar cost average and the market goes down, you're mathematically buying at lower and lower levels. As it goes down, you keep purchasing more and more and more, and you might actually turn into that mental financial mutant that gets excited when the markets go down. I mean, we have tons of clients who fall in that camp. If, however, you're on the other end and you start dollar cost averaging and the market's going up, all of your old contributions are still making money. So either you're making money on the money you've put it to work, or you're buying in lower and lower. It's really a win-win situation when you go with a dollar cost averaging strategy.
What I love about this question is that so much in finance is everybody focuses on the analytics. And I'm a big math person. I love the analytics. But as you learn and the wiser you get, the longer I've been doing this for over 20 plus years now, is that there is much more that goes into success than just the numbers and analytics.
Yep.
So I think this whole topic goes much further into, let's think about what are your goals? What's your age? What's your risk personality? Also, how much money are we talking about? It's very individualized. It's very specific. So, and remember, there's lots of research, Dalbar and others, that show that the average investor, as much as we hate to admit it, we are very emotional creatures. So, we like the thought for larger sums of money, dollar cost average. Now, if you like what you hear here and you want to take the relationship to the next level, I got the perfect tool for you. How about hiring the money guys? You know, Abound Wealth is what we do. We're fee-only financial planners by day. If you like the content, you believe in the abundance cycle where we just give you free information, you grow, prosper, learn, and once you reach a level of success, if you want to come to the next level and become a client, we'd love to work with you. I'm your host, Brian Preston. My co-host, Mr. Bo Hansen. Check us out, moneyguy.com, aboundwealth.com. We appreciate our listeners and our viewers.